today with Andrew Elf, CEO of Mitchell Services. Andrew, thanks for your time.
Thanks very much for having me.
For those who don't know Mitchell, can you explain a little bit about the business?
Yeah, sure. It's the Mitchell brand's got a very long, proud history. It was originally a company that started back in 1969, so 50 years this year. And the family sold that. It was a private company in 2008 to Lucas for a significant amount of money, largest privately owned drilling company in Australia. And then Mitchell Services re-entered the market in late 2013 and came back as a listed company with the aim to grow a significantly large drilling company using public markets. At the bottom of the market, we acquired some companies and assets at the right price. More recently, in April last year, an earnings accretive acquisition, and some good results have come from the last sort of 6 months or a year. And as it stands today, it's a company of 65 plus rigs and 400 plus people, very low debt levels and producing good cash.
Onshore Australia only?
Yeah, correct, onshore Australia only. So Australia-wide operations and surface and underground in the minerals, surface and underground in the coal. So it certainly is one of the most diversified drilling companies in Australia.
How do you protect yourself from the up and down of the exploration game?
Yeah, look, it's a very good question. Our business is predominantly with miners and mining sites, both on the surface and underground. So probably 90% of our work is multi-rig, multi-year contracts on existing mine sites where work needs to be done to support the continuing operation of the mine. Majority of the mines are large, ongoing operations that operate through the cycle. So that drilling continues. We certainly service the exploration space as well, and that work does come and go, given the conditions in the market.
What are some of the key highlights from an operational and a financial perspective over the last 6 months?
Yeah, the recent half-year announcement and the last quarterly are probably the main ones. And we've had some fantastic contract wins as well. So significant debt reduction in the last year. We've announced a dividend. We've announced some big contract wins, some big contract renewals. So you've really seen a business that came back into the market in late 2013 and really a terrible market that stayed down for a long time. But we bought assets at the right price cheaply. We put some fantastic systems and teams in place and are really now getting rigs out, doing a good job, operating safely, and again, just building on that momentum. So I think we've got a really good pathway ahead of us for the next couple of years at least.
And what should investors focus on for the next 6 to 12 months?
Look, I think it's really, in a business like ours, it's about leverage. It's a contracting business, it's a service business. So again, we've only got so many rigs in the fleet, and we've only got a certain number out. So I think at the moment there's about 50 odd out, 65 in the fleet. So there's still rigs that can go out and can earn money. And as the market gets better, the prices will increase, and that will lead to a higher level of profitability. Once our fixed costs are covered, which they are, it drops straight down to our EBITDA line and generates significant cash and leverage. So I think as the business continues to move forwards and the market continues to improve, I think we've still got a really good pathway ahead of us.
A strong business with a great pedigree, outstanding customers. Andrew, thanks for your time.
Thanks very much for having me in.